Good evening, everyone. Welcome to tonight's live stream. My name is David Matney with Nebraska Realty at the Living in Omaha channel. And tonight we're going to talk about NIFA. NIFA stands for Nebraska Investment Finance Authority. And I got a special guest because there's a lot of information about NIFA and there's a lot of stuff that people aren't aware and the power of NIFA. So I wanted to bring on a subject matter expert on tonight's topic, ask some questions and learn more about the program. And hopefully you'll get some information about this that you can definitely use. And tonight, for my guest, I have Erik Soderholm with Fairway Mortgage. So welcome to tonight, Erik. Thanks for joining the program.
Yeah, I appreciate the opportunity, David. It's great to be here, and I love working with first-time home buyers. Knife has been a solid product that we've had for years, and I find myself more and more doing a lot more knife programs, and it's great to get some education around it because it's a very useful product.
Exactly. And then, Erik, if you don't mind sharing, just before we dive into NIFA, tell us a little about yourself and about how long you've been doing in this crazy business and all that sort of thing.
Yeah, I've I've been a mortgage loan officer and advisor here in Omaha for 19 years and
Wow.
some change since 2006. Right out of college, got into the subprime business of all things, and
Yep.
didn't really know a lot better, but at the time it was definitely a need for it.
Mm-hmm.
Learned a lot about structuring loans and how to make things work. Moved from there, and I've been at big banks and small banks, brokerages, everything alike. Fairway's a great company. I've been here for going on 3 years now.
Right.
Great team behind me, and I've got operations for me really controls a lot of how my client's experience actually goes. So having the right people behind you makes a huge difference. And Lord knows I wouldn't be able to manage the pipeline and get through these files with different programs out there with a lot of help. So
Right. There's a lot of different plates to juggle and all that sort of thing. So yeah, your guys over there at Fairway do a great job, and I know you're part of the Greg Acero team and just do a fabulous job with that. But tell us a little bit about, okay, I already kind of took away the first question. What is NIFA and what does it stand for? But, um, tell us a little bit more about NIFA to help us better understand it.
yeah, so NIFA, again, you mentioned it stands for Nebraska Investment Finance Authority. It's a great state, I guess, agency, state program that helps primarily, it's been around since 1983.
Okay.
It actually helps low to moderately low income household families who also fit the bill for a long time of just being first time home buyers.
Okay.
With, it's not a type of loan.
Okay.
Right? It's not a type of loan. We're still talking either a conventional loan, an FHA loan, VA, USDA. Those are your programs, right? This is more of the state subsidy type of an option where they're going to give you some either benefits for being a first-time home buyer and meeting their requirements with whether it's lower interest rates or the ability to get down payment assistance to be able to buy a home with very little, if any, money out of your pocket now that they've made some changes. It's a very useful product, but the NIFA also handles stuff with agricultural side of things as well. But for single-family residents, this is what they're meant for. So it's really meant to help out a lot of first-time home buyers and the need to generate some of that business. So.
Okay, great. Now, it's we get a lot of people that are relocating to Omaha that watch the channel. Can they be from out of state? And if they're, can they still apply for a NIFA loan if they're out of state and they're moving to Nebraska?
Yep, as long as it's going to be a single-family residence, well, depending on the program, I guess you should say it that way. They also do multi duplexes and up to 4 units as well. But if they're moving to the state, if the property is going to be in Nebraska and they're going to occupy it or one of the units as a primary residence, then yes, they can apply.
Okay. Now, how is NIFA different from other types of assistant programs?
There are different assistance programs out there, and we have, to be honest with you, this long doing it, and with Fairway, I don't even know the number anymore, but we have about every product that's possibly known to man. 1,300 so different loan programs. A lot of those happen to be broker channel programs or what they now call non-qualified mortgages and different, everybody has a different setting in life and what the right situation is going to be. The right product tool to help them acquire their property could be different. We have different FHA loan programs. I shouldn't say just we, other people do as well, that have down payment assistance programs that go along with it. Some of them are forgivable. Some of them require payments, how much they allow you to take out, which ones are potentially forgivable. They all have little twists and twines. The thing that's really, in my opinion, great about NIFA is their terms of the loans themselves are extremely competitive.
Okay.
You get to, not to mention the changes that they have always continued to make over the years to be able to, they listen to the consumer, to the lenders, they come up with solutions. We have new products that aren't that old that are able to meet the needs of people that fit into their the demographics of what they're trying to meet. So I have some other programs, but I can't tell you the lot. I've probably done one or two of those because usually if you put those options side by side, whether it's because of the interest rate or the mortgage insurance or the income qualifications, NIFA normally wins out time and time again. So I find myself when it's a first-time home buyer or even not, I catch myself right away checking to see if they meet NIFA's parameters, because I know if that's the fact, I'm going to have some really good options to present to them that usually not a lot of other options can hold a candle to.
Oh, and you said, we was talking about this offline, and you said how the rates, just because they're going NIFA, they're not getting punished in terms of rates. In fact, they're getting some lower than market rates. Is that true?
Generally speaking, yes. They're every now and then you'll catch a few places out there, and especially maybe more so in the last couple of years where interest rates got elevated, right? In a very short amount of time, we saw rates go from historic low rates and really jumping up. So it kind of set people back. Well, last couple of years, 2.5 years or so, been probably some of the most challenging of my career because you're dealing with the raise in rates so unexpectedly and so quick that was all anybody talked about, right? When we're 10 years of almost, I don't want to say artificially low, but forcefully low interest rates to now back to what, I mean, historically, I think the 50-year average is in the upper sevens. So we're not out of the norm. It just seems like we are because, especially to a first-time home buyer, anybody who's, I shouldn't say any first-time home buyer, but a lot of them are in a particular, age range that happens more often than not. And a lot of that age range might always sit there and have only really been paying attention to or knowing rates being extremely low for as long as they can think back about ever buying a house.
They were so
moves that quick. It's a big adjustment. So the marketplace here, it's very competitive when there's not as many transactions because there's not as many homes available for sale, which I believe is personally probably the biggest problem that we have is the lack of inventory. It creates a situation where every bank, every credit union, every mortgage company, everybody's tightening up their financing as much as they can, trying to be as competitive as they can. And when client after client and realtor after realtor are always concerned about, we're always trying to monitor things, right? So there are some instances where I've seen some lenders, not myself personally, but I've seen some lenders that are slightly below even where NIFA's rates are. Sometimes it's I mean, maybe 1/8%, and it's hard in some cases for me to understand how long that'll be able to last because NIFA prices them so low that there's really there's not a lot of profit to be made business wise, right? And nobody's really in lending to do it for free. So there's got to be some sort of a business aspect to it there. But all in all, the rates are either you're gonna have an option. You have options, right? But I thank you for pulling that up. Is that from today?
It's just that's from today.
I printed that off too just to be safe. But what you'll see on this is their website. It's a great website with tons of information. If anybody's not in a dire need and they want to actually educate themselves and learn, especially in the NIFA, you can go to NIFA.org. Takes you right to this page here, and you can click around at the bottom there for home buyers. But it'll go through and explain a lot about the different programs. What do I do with the rates? Give me 1 second. I printed that out. I swear I did. Maybe I just took a screenshot. But ultimately, you'll see on there that it gives you rates for, it says program type. There's military home, first home targeted, first home, home buyer assistance, welcome home, and then welcome home buyer assistance all together here. Plus, right below it, this is relatively new, probably within the last month or two, you see refinance.
Yeah.
So NIFA is now, they just came up here a month or so ago and gave us here at Fairway a presentation telling us that they were going to be rolling out a refinance program.
Okay, yeah, that's I've never heard of that before. Yeah.
It's new. Pros and cons to it, but we have some great products we can kind of compare to that as well. But one way or the other, depending on which category you fit in for their qualifying matrices,
Okay.
and what type of loan we may need to do or want to try to do for the home, in particular home that they're trying to buy, will help depict which one of these programs that we're going to try to focus on. So,
gotcha. Can you kind of walk us through like the first home program? Kind of.
Yeah, not to make it a first time home buyer thing, presentation type of video, because we want to talk about NIFA, but a key piece that will determine which one of these will go into. There's three main pillars that any lender is really going to look at to determine if you qualify,
Okay.
what programs you qualify for, and then how much you qualify for. And I cover this with most buyers, sellers, anybody in general, but it's your credit, your assets, and the debts to income ratio. It is going to determine a lot of these factors. But for first home, which is the way you see here is at 6.25 on a conventional loan, which would be through like Fannie Mae or Freddie Mac.
Right.
Well, let's start off by saying for any of these programs, NIFA has a minimum credit score requirement.
Okay.
So the minimum credit score to be able to hit is a 640.
Okay.
Now, depending on what type of loan or thing you're looking at out there, there are, if you're buying a car, if you're getting a credit card, and if you have a co-signer on the loan, or you get your 3 credit pulls pulled, generally speaking, they usually seem to try to use the highest score on there.
Okay.
When it comes to a mortgage, that's not the same thing. We're going to get 3 bureaus, TransUnion, Equifax, and Experian. Sorry, I turned on my fan and I turned on the heater. I'm used to it being often warm and cold and what it's going to do, so I was sweating in here. But with a mortgage, they're going to take a look at all 3 bureaus. So if you have, let's say for an example, this is usually a pretty wide range that I'm giving you here, but if you have an 800, 750, and a 700, the middle score of 750 is what's going to get used for qualifying.
Okay.
So in an example here that might make a difference is if you have a 650, a 639, and a 620, even though one scores at a 650, the 639 is going to be your qualifying score, and it's below NIFA's minimum.
Okay.
We can't do a loan like that unless we figure out a way to, which we do quite often, figure out a way of, hey, there's a couple of things you might need to do real quick and boost that score up, and we'll quickly reverse it around, a rapid rescore you to get your scores up so we can make a program like this available. But 640 is the first part.
Okay.
In order to qualify for first home, you have to be considered a first-time home buyer.
Okay.
Now, in NIFA's eyes, and generally speaking, most products out there, in our eyes, we think, well, I've owned a home before. I had a home 5 years ago, and I sold it 4 years ago.
Okay.
I'm not a first-time home buyer. Well, they're going to consider anybody who hasn't owned or had ownership interest in a property in the last 3 years. They fall into a first-time home buyer category.
Okay. Okay, good.
So that would meet 2 requirements. If they have a 640 or above credit, they're considered a first-time home buyer. Now, there are income restrictions.
Okay.
It is household income. So we can get, I think you had that down a little bit further. We can get into that later.
Okay.
And then there's also purchase price limitations, right? Depending on how much of a purchase price the house can be. Not so much the loan amount. Right?
Okay.
So Douglas and Sarpy County, generally speaking, I think that purchase price is $384, I believe.
Okay.
Yeah, $384 for a single family residence if it's in a non-targeted area.
Okay.
We can also touch base on the targeted areas. So that changes around their qualifications, the income limits, and the purchase price limits. So it's not hard once you get the hang of it. And there are some on their website, even there's a geo mapping tool where you can actually put in the address and determine if it's in a targeted area or not.
Gotcha. And you can help folks out with that
for sure,
as well.
For sure. It's usually unnecessary to try to do that every single time. Otherwise, you're really limiting yourself to where you're looking to start with. Second of all, if you're making the decision solely on whether it's in a targeted area or not,
right,
you might want to consider some more options. But if it happens to be there, or if that's where you are looking, they even sweeten the pot a little bit. The rates get a little bit lower.
Nice.
And they do allow for a higher price on the house and higher income limits. Right? They're trying to generate some activity there. But so credit score requirement, first time home buyer requirement, not owned or had ownership interest in the property in the last 3 years, and then income restriction as far as not making too much money in the household. So
Gotcha.
it's kind of different versus how we're qualifying somebody. Obviously, credit matters.
Right.
But it's always, I tell people when the lender, myself, when we're trying to make sure that you can afford the home, trying to make sure you make enough money to carry that payment and any other bills you might have. NIFA's sole purpose is to try to make sure that you don't make too much money to beyond their income limits, because they have to meet certain criteria to get their funding, their housing, according to the department or the Nebraska State Legislature. So
gotcha. Okay. We got a comment here. Bob has a wow, that's a lot higher than I thought. Good to know. So
purchase price?
Purchase price, right? Yeah.
Sure.
That's a lot of people don't have that.
I have a nice little cheat sheet at my desk at all times. I know it pretty well by now, and it's on the website. I can't tell you exactly where to go, Dave, on there to click it to know.
Okay.
But it's in there, and it's a homeownership program information sheet, and it tells you the income limits, the purchase price limits. I actually just had a really good situation work out just last month for a client.
Okay.
That bought a duplex. He bought a duplex. He was going to live in one side.
Yeah.
First time home buyer. And the purchase price, we had to do a little bit of negotiating with the seller, but the purchase price ended up being exactly $491,000.
Is that right?
Limit for a 2-unit property in Douglas County.
Okay.
Underneath there, really, it was tight, but we really got it to work. So he was absolutely thrilled because he ended up with a much lower rate than he would have gotten before.
Right.
Yeah, a really good situation. So, like I said, a lot of times, one of these programs can seem to fit really well. So
now they could get a hold of you if they wanted to ask any questions or access to that cheat sheet, couldn't they?
Yeah, for sure. Yeah, definitely. You're always happy to call or text me. I think you've got my office number up there as well, so I'm happy to answer questions.
Excellent. All right.
Through a full-blown application, if we want to get some, legitimacy behind it, do a little bit of due diligence, but if then we want to get an application in, so we can pull credit, kind of give you more of a high-level overview of things. But somebody's just got some questions. Hey, I think this or that, or maybe I'm planning things out. Feel free to call, text.
And I think that's an important point, and that is, even if you're thinking about it, or if you think, well, I'm a little bit start the process early, because there might be something you have to clean up or tweak or something like that, and then Erik can get you on the right path. So I really encourage folks to reach out early in order to, get that component taken care of, because too many people will do it just the opposite. They find a home they love, and they're on Zillow. They find a home they love, and then it's it's gone. But yeah,
I find it common where it seems like it's a ways out, but time goes by so fast that we'll have somebody apply. They made the decision they want to buy, or think that they want to buy. They want to see if they can buy, because they just get the notice that their lease is going to be coming due in 60 days and their rent's going to go up on them. And they're like, you know what? I think I've had enough of this. I'm going to try to get approved. They apply, and we find out that, hey, we're close, or there's maybe your credit could have done a couple of things, or we need to get you above a 640, or, and all of a sudden, even if we had it worked out well, where they apply, gets put together, we're pretty cool, get them out with you to go shopping for a home.
Yeah.
Not a lot of homes. They might have some requirements, have some struggles on competing, just because there's so many buyers and the homes. We need to get them in and active early.
Right.
It's not all rental homes or apartments are going to just willy-nilly let you go month to month, right? Some of them are going to have some restrictions, and we don't want to wait too long to the point where we just miss the opportunity.
Right. No, that's now. What about repeat buyers? What about folks that are not first-time home buyers? Talk a little bit about repeat buyers in NIFA, because I think a lot of folks have the notion that NIFA is only for first-time home buyers, but it's not.
No, and we covered that briefly, like one example. You bought a home, whether you used NIFA or not, doesn't matter. You bought a home, sold it, it's been 3 or 4 years, you move back to the state or don't, you just been here the whole time, and then you want to buy again, you can use it again as long as you meet those requirements. Second piece, which this has been more common lately, I can't say that I advise against it. You might have somebody that, in some cases, we'll analyze stuff, but bought a home in, you know, I don't know, it's 2010, right? Bought a home in 2010, lived there. All of a sudden, interest rates dropped to rock bottom, and they refinanced, and they got a really good rate on that mortgage, or they just bought in 2020 where the rates were ridiculously low.
Right.
And now they've got a bunch of equity in the house, right? And they think they're all of a sudden going to go, they're afraid to kind of move. They need more space.
Right.
Growing family, school change, relocation for work, a number of reasons. But it is really hard to get off of the fact that I'm going to give up this 3% rate I have,
right,
and go get into something that's 6.5%, and try to move up in price. And the payment shock sometimes can be a little bit, off-putting. But they got to do something to some of the other. We found out if you own a home now, you can still do NIFA for a second home while you still carry that one. You don't have to sell it.
Okay.
Now, you might want to have to pull out some equity out of the house, maybe a cash out refinance or a home equity line of credit to potentially use some of your proceeds to help you buy the next house with a down payment, right? But you can actually have the NIFA loan on a house, and you can actually, if you had a NIFA loan on it, you can still do, there's a second program called it was on that other screenshot, it's called a Welcome Home program. So rather than the first home, it's a Welcome Home program. Again, still conventional, still FHA, still VA, and that hasn't been around a long time. It's been a couple of years now. Again, time goes by so fast, but that program's got different restrictions. They're less restrictive, I guess I would say. Higher income limits, higher purchase price limits. That purchase price limit's $470,000 for a single family residence.
Okay.
And again, you can actually have a house now and then still use that. You can be a second time buyer. And not even have to sell your first house if you didn't want to. You just can't have more than 2 financed properties, including the new one.
Gotcha. And then there's like NIFA. Talk a little about VA and a little bit about the USDA and the VA loans too for NIFA too. You talked about that.
Yeah. VA
what
loans
about
are great.
Yes, and what? Talk a little bit about VA in terms of why they're so great. There's a couple different reasons why, but let's talk to the folks about that.
Outside of just a standard VA loan, which are already phenomenal, rightfully so, but depending on the circumstance. So if they are truly a first-time home buyer, and they're going to be using it's on NIFA's webpage, it's called a military home instead of it isn't called VA loan, it's called military home because. If you can pull back up their website, if you still have it there,
sure,
and you show that same rates kind of page, I don't know, I don't have my screen blown up, so I don't know how big this is, but
it's pretty small.
Right there, it says military home, and there's only 2 columns here where it kind of gives you the rates, right?
Right.
So the government rate, military home, that's your VA rate, right?
Yeah, 5.5.
If you do a VA loan today, and they're a first-time home buyer, and they meet those criteria, they can get 5.5% and do no money down payment because VA loan doesn't require down payment. Right? Now, we just talked with them when NIFA was up here. They asked us, what else do we need? What product don't we have? Because sometimes what feels, doesn't feel the greatest is we feel like we should be giving them such a benefit, right? So they have 5.5, but if that military home buyer also decides that they need to get the down payment assistance loan that is potentially provided as well. Well, there isn't like a in-between rate. It goes from that 5.5, and it jumps up to what you see underneath the government of home buyer assistance at 6%.
Okay.
So I wouldn't be shocked because I think they're probably getting this comment more often than not, but the staff from NIFA came up and visited with us, and when we brought that up, because Jackie retired, and now we've got another person there, David, I think it is. They talked about, well, maybe we can figure out a way. They got to go get permission. We can figure out a way to maybe move it up 0.25% and still give them a much lower rate than the other option. But the other thing with NIFA on military home is if you're active duty or in the reserves, you do need to be considered a first-time home buyer underneath their parameters.
Okay.
But if you're a qualified veteran and discharged, not anything other than not honorable, so if you're discharged honorably, you probably have to get E-214 turned in. But you don't have to be a first-time home buyer if you're retired or discharged veteran, and you can still get that military home rate of 5.5.
Is that right? Wow, that's a benefit there, isn't it?
Trick of the trade sometimes. Every now and then, when they're being very competitive out there in the marketplace, if I'm competing against something, not competing or whatever, if somebody sends them over to me and they've talked to a lender, and first thing I do is look through NIFA because I know that their terms are phenomenal. And if it's a vet, I try my darndest to get them into that because I don't have my normal VA rate wouldn't be able to touch that.
Yeah, that's amazing. That's awesome.
Really good there.
Now let's talk a little bit about the home buyer assistance, because I think that is an awesome program. And we were talking about this yesterday, and you went through a couple of scenarios that I thought, wow, Bob has another question here. Let's take this.
Sure.
Are these packages all inclusive, covering closing costs, realtor fee, etc., or is the first time buyer coming to the table with these costs saved for?
Sure.
That's a great question. That's almost kind of a lead in for this a little bit, isn't it?
Yeah. And I'm sorry, I got to get my air conditioner, my fan to blow some cold air on me here. Sun must have got to the right side of the office. When I'm covering how the process works, what to expect. Again, I always cover credit, assets, and debt to income ratio. So credit, we kind of covered specifically just for NIFA, the minimum requirements, but something I didn't touch on, which is can be a huge benefit for a lot of people. These interest rates are set by NIFA.
Okay.
So if you have a 640 credit score, you get those rates. If you have an 800 credit score, you get those rates. So if I had a general person trying to buy a house, conventional loan within the this price point, and they have perfect credit or 800 plus credit score, I'm probably going to get them a rate that's close to that. Right. So if you don't have the greatest credit, but we can get you into first-time home buyer, that's one of the huge advantages of NIFA is your rate is not being dictated by your credit score, where it is nearly as much as it would be if we weren't doing one of these.
Okay, that's powerful.
And NIFA doesn't change their rates all day, every day with the market as it moves up and down, because we've seen a lot of volatility in the market.
Right. Yeah.
So there's instances where I talk to a client in the morning and then talk to them in the afternoon because they called around, and between me and that person back over to me, the rate might have already moved a quarter of a point in one day.
Yeah.
You have some of these big economic reports that are coming out. Well, if I've got a client that gets a contract together, and we know we're going to go with NIFA,
right?
Some of these reports, the unemployment numbers, the inflation numbers, they come out sometimes at 7:30 in the morning, where the market's not even opened up yet, and there's enough good or bad damage or help that happens in the morning before I could have even tried to lock the rate. Where with NIFA, they set the rate one time a day at 9 a.m. in the morning every day, and it only changes if the market's moved enough. So
is that right? That's awesome, isn't
it? So there's certain circumstances where things have moved, and I know it kind of gives me an inside scoop. I know if we should be expecting that rates might change the next day, and then I'll make sure I get it in ahead of time, right? So one big benefit, huge. Somebody who has a 677 credit score, right? If I was comparing a FHA loan to a conventional loan side by side, forget about NIFA for a minute. I know for a fact that the FHA is going to have a lower interest rate. It's going to have cheaper mortgage insurance because it isn't nearly as sensitive to what the credit scores are as a conventional loan.
Okay.
So go with a conventional loan, and we can get in, if we have time, we can get into why that is important in this marketplace right now, why it can be important depending on what happens. The rate's going to be higher, and the private mortgage insurance is going to be significantly higher. But if we go through NIFA and we go with a conventional loan, you're getting a phenomenal rate, lower than probably anybody was going to get, even if they had the best credit. And if we happen to go with a conventional loan, they also offer discounted private mortgage insurance.
Nice.
Which is a big win. It can be pretty substantial. So there's the first aspect. So credit we always cover, and we'll look through the programs. We'll put them side by side. And then we can get back around to why, a big portion of my career, I would say that my business was about close to 50-50 on how much was conventional and how much was government, FHA and USDA.
Yeah.
But in the last 2 years, I would say I'm probably 75 or 80% conventional, and 15 or 20% or so on government loans. Now,
right.
Not that it wasn't the best product, but there's a reason why conventional has been king here lately. So, assets, right? This is the second thing we look at, and this kind of addresses his question about are these all kind of an all-inclusive package. So, no matter which one of these loans or any other loan you do, it's generally speaking, sometimes there's a fourth or even a fifth, but normally it's always going to be the money that's needed to get your transaction done on a purchase is going to be the combination of your down payment plus your closing costs, plus what's technically called prepaid items and reserves. Even on our forms that we send out, it drives me nuts. They lump those into one box that says closing cost.
Right.
Yes, it's a fee that you're paying at closing, but it's not cost from us or from the lender. It's your taxes, real estate taxes, and homeowners insurance. Right. But down payment plus the closing cost plus prepaid items and reserves is going to give you your total. So whether we do a NIFA conventional or FHA or VA, those program guidelines still stay the same. So with a conventional loan, the minimum down payment is 3% of the purchase price, not 20.
Right.
You can do a lot less. So if we can do a 3% down program, if I use an example here, if we find a $250,000 house, 3% down would have been $7,500.
Right.
Now you add the closing cost, and those can vary a little bit. But another key thing about NIFA is they set the closing cost. Right? So if you work with me at Fairway or somebody at Wells Fargo or First National or any lender that is a approved lender to do business with NIFA, you're going to get the same rate and essentially the exact same closing cost. There are some changes potentially on the welcome home side of things, but they cap the lender fee at $1,200. So as I'm going to read through some of these example of what the closing cost would be similar to, inside of it, there's only $1,200 going to the lender.
Gotcha. Okay.
All of the rest of your closing costs are from a third-party service. The appraiser, a credit report, flood search, title work, recording fees, and then if you decide you want to have, a sewer scope, a home inspection, a radon inspection, termite, those are all a la carte. You don't have to have them, but a lot of cases, somebody like you would be able to highly recommend whether you think it's necessary to have or not have.
Yep.
But if you kind of take that out of the mix, generally speaking, the closing costs are going to range between, $4,200 to maybe $5,200 inside of this price range. And the reason why I can't tell you the exact amount is because I don't know how much the appraiser that gets assigned is going to charge, that person's going to charge, or the credit report, or the flood search, or the recording fee, or title. It all kind of depends. Yep. So I always try to range high. So if I was going to give you an estimate here, I'll even go on the high side and say $5,500. So we did $7,500 the down payment, $5,500 for the closing cost. Now we're at $13,000 right now. Right. And then we have to count for real estate taxes and homeowners insurance. And I'll just throw in some number, right? Let's say it's going to be $6,500. Right? So $6,500, and we can get into those details if you want, or if anybody wants, and we have time. That puts the total needed at about $19,500. Again, that's the down payment, closing costs, and taxes and insurance. Now, if they just did a conventional loan through NIFA at the 6.25%, the first home one there. Right. This is how much we would need to verify. Who and where is it coming from? We can always try to get the seller to give some sort of a seller credit, which isn't the easiest thing in the world right now. The market's heating up, so if it's competition, that can be challenging. Otherwise, checking account, savings account, 401k, IRA, you can sell a car, a part gold, a really nice baseball card. We just have to document everything, right? Right. You can't just have a IOU from somebody. Now you can get a gift from mom, dad, sister, brother, cousin. We just have to again document it. It's kind of like dotting the I's, right? Right. Now, if we switch to that to try to include as much of it in as we can to minimize the amount of money out of pocket. That's where that home buyer assistance, the HBA, right there on the side on the website. I'm pointing at this like you're here with me. That's where that home buyer assistance program kicks in, right? It's essentially considered a down payment assistance. So what NIFA allows with that program is one, instead of getting 6.25%, they're going to raise the interest rate on the first mortgage by 0.25%. Goes to 6.5%. Yep. It stinks, but it's not that bad. And when we look at the numbers over a 30-year term, generally speaking, it doesn't seem to make a massive difference in your payment.
Right.
What it does do then is it's still the same down payment, still the same closing costs, still the same taxes and insurance. So we're still at 19.5, but NIFA will then allow you to take out a second loan at 1% interest.
Wow.
That second loan is that you pay back over 10 years.
Yep.
There is no prepayment penalty, even though I'm not a huge fan of trying to pay off 1% money real fast.
No, that's free money.
But it is going to factor in an extra payment. You're going to have two loans, first mortgage and then the down payment assistance. So the payment's a little bit higher, but as you pay that off, that payment will go away. So your budget will come down too. Now, the most that they will let you take out on that second loan is 5% of your purchase price.
Okay.
I shouldn't say the most they allow. I'm sure that there's some ramifications, there's some reasons for that there, but 5%. Sure. So if we do $250 for the purchase price, that in this case, that would allow you to take out a second loan for $12,500 that can be applied towards our total of the down payment, the closing costs, and the escrow of 19.5. It's going to bring down the total money needed now to $7,000 total.
Wow.
Now, where we can try to combine things, and with a great realtor like David over here, we can use ourselves in and figure out a way to say, all right, let's try to negotiate in some sort of a seller credit, right?
Right.
So on this example, specifically because of the down payment, the minimum down payment we did, there are rules as to how much you're able to, even if the seller agreed to it, you can only get so much based on your down payment.
Right.
In this case, we'd be able to get up to $7,500 if we can negotiate that in.
Right.
So when that happens, if you get a $7,500 seller credit, and we were down to just needing $7,000, well, now you bought that home with zero money out of your pocket.
Exactly.
So,
and talk about that, because a lot of folks don't understand, or maybe you can kind of enlighten us a little bit on terms of, that purchase price of $250. You could always make the purchase price $255 with a $5,000 credit. So there's ways of structuring it in order to get that credit.
Yeah. So if I'm the seller, if I'm selling my house, and let's say I had my house listed for, I don't know, I'm going to make it easy here. Let's say I had my house listed for $260,000 over the winter, right?
Right.
My house needs a little bit of work. I'm older and I don't have the capabilities. I don't want the hassle of trying to paint my house and do other things. I need to get rid of it, right?
Yep.
So I had it at 260, but it was kind of a colder season. The house sat. And my realtor and I decided, you know what, I got to get this sold. I'm going to cut my price down. I'm going to cut it down to $250, $10,000 less. Right. Well, if we came in and said, hey, Mr. Seller, you came into me and said, I'll buy that house for you for $250, but I want a $7,000 seller credit, because we know now that that'll get you to buy the house with no money out of your pocket. Right. Well, then essentially, if I'm selling it for you for $250 minus the $7,000, it'd be the same thing as you coming to me and offering me $243. Exactly. Well, I just cut down 10. Through talks back and forth, we can kind of determine that I'm not going a penny under 250. That's the goal for negotiation. Yeah, what's the seller's bottom line, right? Just tell us up front. We'll make this work quick, right? But if it's 250 is my bottom line, well, we just know. Now this is the easy way, because we just know that I dropped it 10 grand, right? Right. So my agent and myself at one point believed that house was worth 260, and it just didn't sell at the time. Bad timing, whatever the case is. Yep. Well, in that case, exactly what you said. If I'm not going to go off at 250, but we need to get the buyer down to where he or she has very minimal amount of money out of pocket. In this sense, it would make all the sense in the world to come back to him and say, how about I give you 257? Right. With a $7,000 seller credit. So with that being said, for me as a seller, 257 minus the $7,000 seller credit, I'm back to my 250. Exactly. No sweat off my back. All right. Yep. And for the buyer, buying the home at 257, the closing costs are the same. The title fees might go up $25. Right. The taxes and insurance needed, that's the same. But your down payment is 3% of the purchase price. So instead of having a down payment, what did I do here? 250 at 3% down. The down payment, I think, was 250, 3% down was going to be $7,500. Yep. If you move it up to 257 to get that $7,000 seller credit, my down payment went to $7,710. So my overall number, instead of being $19,500, went up $210. but then I
Right.
got the $7,000 seller credit, which, the aspect of credit, assets, and debt to income ratio, if my credit's fine, and
Right.
maybe my debt to income ratio is where it needs to be, which I think we'll probably get to here shortly. Maybe that's not my concern. I'm not overly concerned about the payment on the house. I don't have a lot of assets sitting aside. I had my transmission go out and I had some problems over here and something burned through it. I had to pay into taxes. I thought I was going to get the money back, but I had to pay in. So I'm a little bit short, but I love this house. Well, here's the situation where then, if that's the case, then we find the right tool and we negotiate the right way. Well, you can still get into that home, and ideally with as little as zero down for a long, I should say zero down, zero out of your pocket. You still have 3% down. You still have the closing cost. Everything else is the same. We're just covering it with that down payment assistance second. Right?
Yeah, that's awesome. That's
for a long, long time. Maybe I don't even know the exact date. I should have looked this up, but for a long time, the requirement was that you had to have $1,000 into the transaction. NIFA had that rule.
okay. Yeah, I thought for a while there was that they did they get away with that? Did they go away with that then?
They did, yep. And it was interesting enough because I think when they rolled out this plan, something special, but we knew about it. We knew it was coming.
Right.
And I think I might have been one of the first people in the state that had one of these programs going where I was getting it worked out. And here was the interesting piece. Hold on a sec. Let's before I get into that, I think Bob's still right. He said, "Thanks, Dave. You may have missed these earlier. The programs also extend to townhouses and condos." No, townhouses and condos for sure. It's a really good trick of the trade because condos, no problem, right? I mean, I should say townhouses, no problems.
Okay.
Condos, if I wasn't doing a NIFA loan, just pricing out a condo purchase for somebody.
Right.
There's, in the lender world, we call them like loan pricing adjustments, right? So when you're doing a condo, the interest rate you're going to get, the terms for a condo aren't as attractive as they are for a townhouse or a single family home.
Gotcha.
I can't exactly tell you why, but there's a hit to the rate, right? It's not dramatic, but it's enough that it kind of goes, ooh. Well, you don't get that hit when you do NIFA.
Nice.
So you can do NIFA 6.25 today on a condo, where if I was going to do the condo again, even if everything else is perfect, that condo rate's going to be even higher than what it would have been. Right? I can't even get as close to this one. So I use that quite often.
Okay.
What was I going to say here though? Credit, assets to income ratio, we covered that. The $1,000 down. So you had to have $1,000 in the transaction in the past, and I remember scrambling multiple times over to, we figuring out again, since we don't know the exact closing cost or how much your homeowner's insurance is going to be or what the tax prorations are going to be. As a lender, it gets pretty challenging to try to give them really accurate numbers and not overshoot or undershoot, knowing that it's a process and you start in one spot. And when you get to the closing table, some of those invoices are going to come in and the numbers are going to shift. So over the years, you get pretty good with kind of putting it at a certain spot. So at the end of the day, you're pretty close. But when you're trying to get somebody exactly to zero or really close to it, it's really challenging. So in the past, when you had to have $1,000 into it, we would catch some problems trying to get to the closing table because once they're fully balanced, you used to have to go back to NIFA to tell them how much your second loan was going to be that they would approve and come to you. You had to make adjustments on the fly because the fees were a little bit less and they didn't have $1,000 into it. So then you were trying to grab the invoices for the home inspection or anything they paid out in advance. It was this whole nightmare of a situation.
Okay.
Not for the client, for the lender, trying to get it to the point where we have the numbers close enough that we could get them right there, right? And when you're really getting down to where we have minimal assets that we can verify a lot of times, it became a challenge. So what they did is they got rid of the $1,000 requirement, but when they first did that, I actually had this come up once and we didn't get the deal put together. It was the first time I think I've ran into this. So maybe you ran into it, but when you write an offer on a house, generally speaking, is it common practice that there's going to be some kind of earnest money deposit?
Yes.
Can you explain the earnest money deposit a little bit on what that is and on how it works?
It's negotiable, but when you write a contract, you got to show the seller that, hey, you're serious about making an offer. And typically what you'll see is, on a $250,000 house, you'll see, a $2,000 or $3,000 earnest money, and it's held in escrow, and then it gets applied to the closing costs at closing. So it's still the buyer's money. It gets applied to the closing costs at closing. So that's
exactly. So you write that check when they accept your offer.
Yep. When you write an offer,
cashes that check and holds on to the money.
Yep.
And that money is going to get applied to that same down payment closing cost escrow. So if I needed, in that example, before we factored in the second loan, we needed 19.5. So if that would come off of there at the closing table. You get credit for it at closing.
Right.
Well, all of a sudden, when they got us down to the work, they said you don't have to have zero money into the closing table.
Right.
My first client that I had do this, they did, I think, a $3,000 earnest money deposit.
Right.
We had a seller credit factored into there, and the NIFA down payment assistance, the hubba behind it. In my mind, at the closing table, I was going to have the title company give them back their earnest money deposit.
Right.
But because it was so new, NIFA said, no, you can't do that. They can just have no money into it. And I said, well, a couple of us here basically got into it at the same time when we called them, and they're so great.
Right.
And they looked it over and they said, you know what? I think you're right, because, as long as they don't get more than their earnest money back, it's fine. Because I had never had somebody get it, maybe try to make an offer, but I don't think I'd ever got one put together unless they were buying from family or something.
Right.
Where they knew where there was no earnest money deposit.
Right. Yeah.
So for them, part of the tactic of structuring the loan the way that we did was because the home that they were buying, we were paying off a bunch of bills with their cash. They had repairs they needed to do to that home to make it what they wanted to. So having every bit of their cash reserves in hand was more important to them, including that $3,000. Than having the payment be marginally less, right?
Gotcha.
So part of the original plan that we had talked about when this came out was that we're going to get you back your earnest money deposit. And then as we were in the process, I was told, no, you can't do that. And then about a week later, before closing, they changed their guidelines and said, now you can get it back up to the earnest money deposit. So that was a big win. But a lot of times when we tell somebody that exact same thing, down payment, closing costs, escrow, now you have no money to closing. Well, a lot of times you're still going to need to account for and probably pay the home inspection, right? Don't you normally have to pay that at the time it gets done?
Yep.
And the earnest money deposit and some other items. So there are some expenses, and we usually factor in an appraisal deposit of some kind as the process goes on. So at the day of closing, we can either, if all things work out the way we want them to, get you back your earnest money deposit. You have zero money into it outside of some of those other items. You have to be having a little bit around to be able to take care of those items. So,
gotcha. All right, Bob and Bob, these are great questions. So feel free to ask away. That's what this is designed for. So absolutely, these are great questions, and I guarantee other folks are going to have them in the replay and things like that. So you don't have to be sorry about asking questions. Ask away. So. Sorry for the questions, but this is very informative and extremely helpful. Can you front load the escrow account a couple of grand to cover next year's tax shortage after buying?
Generally speaking, I mean, do you have anything on that, David? I feel like I'm just...
No, go right ahead. Nope, you take that one. Yep.
So there are now laws in place, right? There are problems in the past, years and years ago, where there would be, and I don't even want to call it this might have been true in some places. I don't know. It used to be back in the wild, wild west when I got into it, right?
Right.
But there for a while, everybody was saying, well, and maybe this was the case. I don't know. I don't want to think that it is. But if the bank, all right, this bank services 10,000 loans, and all 10,000 have an escrow account, right? And that means that your taxes and your homeowner's insurance are being in these escrow accounts are being held by the bank, and then those are being paid out when the bills come due.
Right.
Well, if that bank or whoever was taking all of everybody's money and dropping it into an interest-bearing account, then they're making money off of your money. Right. And you can no longer do that. Even if there ever was a thing, you can't do it anymore.
No.
Second of all, the title company has a closing department, and my company has a closing department. And at the end of the day, before you get to the closing table, they do this little balancing act back and forth.
They sure do.
All the actual invoices. They get the exact tax prorations to and from, or aggregate adjustments back and forth, your exact homeowner's insurance. And to some extent, we can try to cushion it a little bit, but nobody's allowed to pad the account and nobody's allowed to short the account. And even if we tried to, if you wanted to, the buyer wanted to, and we put more in there than necessary, the account gets an escrow analysis done once a year.
Right.
And when they do that analysis, if there's too much money in that account, they have to give it back to you in a refund. So you'd have an overage in your escrow account, which doesn't happen very often, but it can in that case. Now, what he mentioned was, what Bob had mentioned here was a couple of grand to cover next year's tax shortage after buying. So just so we can get into those prepaid items and reserves, what time is it here? 7:50.
We got plenty of time. Just go right ahead.
All right, my bad.
Yeah.
Everybody tells me I talk too much.
No. This is great information. So
with the prepaid items and reserves, right? So what that is, well, let's start it off this way. When you close on the loan, you're going to get a monthly bill in the mail, right? And every single month, it's going to tell you, here's your balance on the loan, what your interest rate is, and how much your payment is, and then what your payment is usually made up of. How much is principal and interest? How much is taxes? How much is homeowners insurance? And if there's any kind of PMI or mortgage insurance on there for your total payment, right? And then somewhere on that account, it's going to tell you what your escrow balance is.
Right.
So what happens when you make that total payment? My dad was an art teacher, so I'm a visual guy, so I'm literally. But your total payment at the bottom here, all right? So each month you make that payment, it takes the principal and pays down the balance. It takes the interest and pays the interest. And if there's mortgage insurance in there, that goes and gets paid. But the homeowner's insurance portion and the real estate tax portion of your payment doesn't go pay anything. It goes and gets dropped inside of your escrow account. It's a forced savings account, essentially, that when your homeowner's insurance bill comes due, State Farm, Farm Bureau, Geico, that type of thing, that bill comes due once a year, it automatically pays it out of there and your balance goes down.
Right.
But each month that you make a payment, the tax and insurance go into that account and fund it. It gets bigger and bigger and bigger, just like your savings account would. And then when homeowners and real estate taxes come due, it automatically pays it out and those balances go down. So when you first buy the house, there's no money in that account, right? So when there's no money in the account, when you first come to buy the home, the prepaid items, you have to first prepay the entire first year's worth of homeowner's insurance. The first 12 months is due on the day of closing. So today's the March 25th. If you bought a house today, part of your money due at closing, you're paying the insurance, the homeowner's insurance, from today till next March 25th of 2025.
Right.
Now, if you close today, you wouldn't have a payment due the rest of March, all of April. Your first month's payment would come due May 1st. Now, if you start making payments on May 1st and 1/12 of your annual premium is inside of your mortgage payment, then by the time next March comes around, you only would have made 10 payments in that escrow account. So there wouldn't have been enough money in there to pay next year's homeowner's insurance bill when it comes due. So that's where the 3 months of reserves are also needed at closing. So 15 months total, because 2 of those months, plus the 10 that you financed that you paid in with your payments, is going to have us 12 next year with a 1 month running balance.
Right.
Now, if I tried to put I know we're not talking taxes, it's homeowners insurance, but if I tried to put 17 months in there, it's going to be too much, and that money's going to have to get kicked back to you. And I don't even think you would get it that far. People are going to go, whoa, you have too much money, you can't do that. Right?
All I know is the escrow account is very heavily regulated, and way back in the day, the reason why it's heavily regulated is way back in the early 1970s, they were charging banks were taking advantage of folks. And correct me if I'm wrong, or if you hear differently, but my understanding of it is banks were charging some folks excessive, making people come in with they were forcing people to pad the account, while other people were not, forced to do that. So it was a fair housing component to it as well.
Ever since 2008, it's pretty tough to get through anything without being a triple check.
Right. And I should know the laws.
Pros and cons. It's all good.
No. Now let's talk about this real quick. Oh, Clark. Hey, Clark came in. I didn't.
His question real briefly for you, because he mentioned taxes. Let me mention one thing on his taxes.
Sure.
So the escrow shortage a lot of times can happen primarily with a new construction home, because real estate taxes are also collected at closing, but it's based on when you close, when those next taxes are due, what you might owe back to the seller.
Right.
And if your lender sets it up properly, and it should get through there without any problems, you really shouldn't have an escrow shortage the next year or the year after that, unless your real estate tax value increases and so do your taxes exponentially from what was there, because the title, everybody verifies what it is at the closing, right?
Yep.
Now with new construction, a lot of times the taxes that are actually due and payable to Douglas County at the time are just based off of the lot, off of the dirt that was there.
Right.
Because when the county came out to assess it, it was only the dirt. I mean, the house wasn't built there yet. And then they build the home, and the county only comes out to assess it once a year. So you might have 1 year or a year and a half, or sometimes depending on what time of the year you close and everything else,
right,
where your required payment might only have 50, 60 bucks in it, or 90 bucks in it.
Yeah.
But then when that county comes back and the house assessor value jumps from 35,000 to 220,000, well then yes, your taxes are going to go up exponentially, and the escrow company, the mortgage company, is going to do that analysis at some point and go, whoa, we haven't been collecting enough money to make that kind of a payment, so now we do have an escrow shortage. And they'll give you a couple of options. One of them is primarily like, you either give us X amount of dollars now that we're short, and we're to fund into your escrow account, and we're going to have to increase your payment to make up for just the higher taxes. Or if you don't have that money available or don't want to give them that money, let's say it's $2,000 that you're short. They would take that $2,000 you're short, divide it by 12, and add that on top of what the payment was already to go up anyway, so your payment can really jump a lot. Anyway, hopefully that helps with the escrow side of things.
Okay, Clark had a question here. Hey, David, jumping in to listen the last couple of minutes. Not sure if you mentioned this in the beginning. Is this NIFA program utilized nationwide or just in Nebraska? And unfortunately, Clark is a friend of mine from Atlanta, Georgia. And unfortunately, Clark, it's just for folks living in Nebraska.
I would tell you, I'd be pretty positive that Georgia probably has a similar product, similar agency. Iowa has IFA instead of NIFA.
Yep.
I'm licensed only in Nebraska and Iowa at the moment. I didn't continue some of my other states. But I think Georgia, most states have something like this.
Something similar along that line. Yeah. Yep. Okay. And then Bob has another question here. Last one mentioned earnest money earlier. Let's say the sewer inspection comes back with roots in the pipes, which that happens, and you decide not to buy. Guessing you lose your earnest money as you're under contract. And that is not the case because one of your contingencies. Now, here's the thing. The earnest money has to be agreed upon between buyer and seller. Okay. And then, but I just had this happen where, sorry, I was hiding you there. But we just had this happen where they did these.
We did.
Yeah. Buyers that we're working with. The sewer scope came back with tree roots in the main sewer line, and the buyers got their earnest money back because it was contingent upon inspections. And a lot of sellers don't realize this, and sometimes agents don't realize this. You have a window of time to conduct any and all inspections. It's not just a whole house inspection. It can be a sewer scope inspection. It can be a radon test. It can be a roof inspection. You can have an HVAC contractor go out to the house and inspect the HVAC. So you can, it could be a mold inspection. So it's not just a whole house inspection. It can be inspections with an S. Okay, so
that's specific to the verbiage that in your contract, right?
Right. So, okay, that, yep, now here's the thing too. You can always, the ultimate disposition of an earnest money, even if the seller is, let's say the buyer just up and changes their mind at the last 10 minutes before closing. Okay. That earnest money should go to the seller, but it has to be agreed upon by all parties. And if it's not agreed upon by all parties, then it goes to a courthouse and then a judge decides. So never say never. I actually had that happen, Eric.
10 minutes?
I was pulling into the title company, and the buyer called me and freaked out and decided not to buy 10 minutes before closing. And let me tell you, yeah,
That's rough. I've
that
had
was a
things
rough
like
call to
happen
make.
too.
That was a rough call to make. And it was an agent here at Nebraska Realty, and I had to call that. It's kind of a long story, but
It gets a little bit interesting once you've been in it long enough and you've had a
yeah,
number of different scenarios happen, because I catch myself more often than not also, and maybe talking to the buyer sometimes too, but more often than not also remembering that in one way, form, fashion, or the other, there's also a family on the other side that's counting on these things happening. And
I
sometimes
know.
it's a trickle effect and so on and so forth. But, it didn't close later. They didn't just postpone it and then get back on track. It just died.
No, but you know what? And you know what? There's a long story behind this thing.
Another time.
I've shared it in another video, but uh, let me just say, from that moment on, it took like 4 or 5 years. About 10 minutes before every closing, I was like, PTSD after that. I'd be
For
like
sure.
10 minutes before closing, but you got to understand that anything can happen in real estate. So it's not over. It's not closed until it's closed. So MOH says, I didn't think I'd be at the store so long. All right, MOH. Now let me ask you this. For NIFA, there's no, because a lot of times people are concerned if you're a seller. Should a seller be concerned if it's a NIFA loan?
If they're concerned, my suggestion would be, and not all lenders are going to do this, but my suggestion would be to call the lender and inquire. Hey,
Right.
Is it NIFA? Can you, is it just regular NIFA? Is it a hub? I mean, you can have some sort of a professional conversation without disclosing specifics type of a deal, but they shouldn't be concerned because it's either a conventional loan or an FHA loan. Again, the only reason, there are many cases, I just explained, there are many cases that I take a client and we go conventional NIFA because I can get them 6 1/4. And if I didn't take them NIFA conventional, maybe it was 6 1/2. So I'm trying to pick the best terms for my client. If it fits, get them the best rate, get them maybe discounted private mortgage insurance. And we do those programs so well and so often that there's no disruption in your time frame from start to finish. I think we close those things. I mean, we've done them in 15 days on a very regular basis. I'm not pushing for that, but it doesn't take 45 days to do one by any means. Now, in some cases, if you're going in, like one of those examples we just mentioned was, hey, I need this price and I need this big of a seller credit and we're doing a NIFA loan, and they're thinking, well, are we okay? Is this really approval? Do they, I was mentioning, I had that exact same thing happen, and my buyer didn't have $500 to give for an earnest money deposit.
Mm-hmm.
And that was on like a $300 and some $1,000 house.
Right.
So the seller's agent called me and was like, hey, they're not willing to do any earnest money deposit. Are they really okay? Now, I couldn't go into details, but with that client, they had money tied up in another area. And matter of fact, I think they were actually helping out a local church at the time. So they just didn't have it right then when the right house came up.
Right.
So I don't think they ended up getting that deal put together, but they found a better house later on and it all worked out.
Well, one thing I like, and I don't want to, maybe I will give away a trade secret here, but what I like is you reach out, you'll reach out to my client and you call the listing agent and you have that conversation, because here's the deal.
Why wouldn't you?
All pre-approval letters are not created equal.
No. And I've witnessed that firsthand. There's a big difference. I mean, myself personally, I've even had it, right, though. So there's a pre-qualification, which is what a lot of people actually, the status they're actually in. But then there's a true pre-approval, and then there's a loan commitment as well. But a pre-approval, I mean, a lot of times you fill out the application online or over the phone, and what the client tells me or fills out and what their credit says.
Right.
I run it through an automated underwriting system, and if it says yes, hey, you're pre-approved. Well, no, you're not. You're pre-qualified.
Right.
Pre-approval is a little bit step further, where I've done, or my team and I have done, some due diligence where income and asset documents have been turned in. We've looked at them and made sure that what's in the system is accurate with what's actually on here. Human error, sometimes a mistake. we work off of gross income. Sometimes they put in taxable income or
Right.
one extra number, anything else. So doing a little bit of due diligence to try to get into an actual pre-approval is definitely important, but not everybody's doing that. Just like not everybody's calling the listing agent. It's shocking to me when I do that and the listing agent will go, "Oh, well, thanks. I've never had somebody call me before." I mean, who are you? And then, so that for me, that's great because it allows me to try to find other good agents that also are looking for good lenders to go a little bit further and just do what's right. It's the bare minimum. It's the bare minimum. It should be mandatory. So
no, but believe me, it's not. It's not. I mean, nope. Let's see here. Did I get that one? After Erik gets the buyer confirmed at the rate and amount, how long does a buyer have to find a property? Is limited to 30 to 60 days? Is there a limit on extending if need be? Great question.
Yeah, that is a great question. It's come up more and more often here lately. And to be honest with you, the last couple of years, the time it has taken on average, not just here, but industry-wide, I would imagine, for a client to apply to when they actually close on a home has extended. Right? Unless you're lucky or you're working with the right people, a lot of times, and even then, luck of the draw sometimes, right? It's a challenging market. But generally speaking, your credit report itself is usually valid for 120 days. So if you pull credit and you close on a loan, a purchase within that 120 days, we typically only had to pull your credit once. If you're going to close on 140th day, at some point in time there, we're going to have to get a new credit report ran before it expires to make sure that something in your credit hasn't changed. Income and asset documents, pretty commonly across the board, are usually valid for 60 days.
Okay.
Before we need to get, it doesn't mean you're no longer approved, it just means I need to get updated documents to make sure that your pay hasn't changed or you didn't, buy a car and you paid cash or something, or got mom a new pair of shoes or whatever the case is, right?
Right.
So 60 days, good window. Now, as you're getting pre-approved or pre-qualified or shopping, you're going to want to, if you have a computer or a tablet, or maybe you just have paper school, like old school, like I do, you're going to want to start a little file, whether it's on your computer. And there's a document checklist tool. You want to keep together, start saving your pay stubs and find your W-2s and get your tax returns and your bank statements. And then just everything's done, almost 99% of it's done digitally. So you have the ability to download, upload securely into a portal. It's pretty simple stuff. So it doesn't seem like it should be that hard to go get your hands on some of these, but the most common and a lot of times frustrating thing, let alone a client, because I totally understand, is almost every single time we cannot use screenshots. Can't take if you have an app on your phone, how you check your balances and do things, that generally isn't going to, even if you try to do stuff on the app, it's usually not going to have the requirements of what that document needs to have for it to be considered verified, right?
Gotcha.
So with a simple conversation and maybe some help, we can obviously help with that stuff too. But I usually get a lot of screenshots or a picture with the cell phone, and those work, but they have to be legible and cover a certain amount of stuff. So.
And if you are pre-approved, don't do anything. Don't go out and buy a car, or don't go to Nebraska Furniture Mart and start buying furniture or anything like that.
You can
but talk to your lender first.
Just ask or say, hey, I need to do this or this. Just communicate. You don't have to ask, you can just communicate.
Exactly.
And then you can communicate back, no problem, or thanks for letting us know, no big deal. And if you've had a proper pre-approval in advance, a consultation, a discussion, a breakdown of the loans and how it works, then it doesn't normally happen because the client already has an idea of what to expect and why, when, and where. It's not just a stamp, hey, what you said works, and then I hope that we don't have a hangnail later. So
right. Now, a NIFA loan doesn't take any longer than any other type of loan, does it?
No. There is some more paperwork that has to be signed. It used to be a little bit of a hitch, but they changed it because at the end of the day, we had to go and send how much we determined that second was my closing department had to send to NIFA how much we were going to do for the down payment assistance.
Okay.
Then you have to wait for somebody outside of the company to review it, to tell you it's okay, to give you the green light, and you pull in some documents and that sort of thing. So, but you don't have to do that anymore. So, no.
Is there a required education component to it? Because
there is. There is, and there is a key piece in as far as the income limit goes, and I'm just shocked at how often this piece comes up. But
Oh, excuse you.
If you are a first-time home buyer using First Home or any of these programs, they're going to require that you take, if either one of you are, they're going to require that you take a first-time home buyer education course.
Okay.
There's multiple different options. We send out a link in our process to the clients. It's online. You can do one in person too. If you've already done one and you got the certificate from it, you can usually use that.
Okay.
But there are some ones that are like providers that don't meet the standards, right? For Fannie or Freddie or FHA. But you can take it online. It's free, costs no money. It used to be, about a 20-minute process and a 15-minute question that was, I don't want to downplay this too much, but it was like, should you buy a home if you can't afford a home? Is it a good idea to budget? Right? It was really common sense stuff.
Right.
And I could have a client that was in a push or didn't have to do it or sit at my desk and they could open it up. I'd turn it over, give it to them, and they'd be done in 10 minutes.
Right.
It's now actually a pretty good course. And
good.
Don't sit down for 10 minutes. This will probably take you an hour, hour and a half, even if you're on it.
Right.
But when you finish it, you're going to get a certificate that says you completed it, and that has to be turned into your lender.
Gotcha.
Now you can do it in advance. It doesn't mean like you have to wait to do this. You could go take the course and probably become smarter about the process and how it works anyway. And then you'll already have that ready. But one of the most common and disheartening things in certain circumstances, and also frustrating for me to deal with determining if somebody can do the first home program with the really low rates, or if they're going to have to go into a welcome home program, or if I have a different one, right, is income limits.
Okay, yes, talk about that.
So again, when I'm trying to make sure that somebody makes enough money to qualify for the home, we usually take some sort of a conservative approach to not just me, but the guidelines for lenders, right? If we're going to go Fannie or go Freddie for conventional or FHA, we have to pull out the guidebook and how do they treat paid by the hour? How do they treat commission or bonus or overtime? And if you have 2 years of this or 1.5 years, can you use it? Can't you use it? You have to kind of figure out what's going to go into me being able to say to my underwriters, hey, they make enough money per the guidelines, they're approved.
Okay.
But then NIFA takes a look at the income completely differently. They're more of an aggressive approach. So all your overtime, all of your commission, all of your bonus and everything else is going to go in to make sure that you don't make more than their suggested income limit to fall outside of their guidelines for low to moderately low income households. Okay. And that household, on my end, if I have a husband and a wife, make it easy, right? And maybe the wife or we'll say the husband, right? Maybe the husband's credit score is a 632. Okay. And the wife's is a 677. Gotcha. Well, I can't have the husband on the loan and do NIFA because his score, the lower of the two middle credit scores is what gets used for qualifying. And if he's a 632, then he can't be on and do NIFA. Okay. So first I would try to help figure that out if we needed to. But in some cases, maybe we don't need him. Maybe his income, they qualify with just her income, or he doesn't work or anything else. It's all good. Okay. We figured out a way to still do it with her. Okay. But maybe he does make income. The credit wasn't there, so we couldn't have him on. Okay. Gotcha. So for my purposes to get him qualified, I can only use the applicant's income, just the wife's income to meet the guidelines. Right. But for NIFA, they consider household income. Oh. So anybody who's over the age of 18 who's going to be living in the house, if they make money or not, their income also has to be submitted to NIFA for them to review the household income. Gotcha. And for Douglas and Sarpy County, for 1 to 2 people in the household, that income limit's $109,500 as of today. Okay. Now, let's say it's a husband, a wife, and they have a newborn. Right. Well, that's 3 people. Okay. 2 of them are over 18, but the child is a third. Right. Or a mom or a dad or somebody else living with them. Well, 3 or more people, the income limit jumps up to $125,925. Okay. Right? Okay. But because NIFA does their own income calculations that are different than the way I've always done it, right? I'm trying to use a lesser amount and make sure that I have plan B and plan C, and I could probably use a little bit more if I needed to, just to make sure I'm not threading the needle too tight, right? Right. A backup option. Well, I've done some training, and I do have they provided the lenders, here's how our income calculation is, right? Right. But in most cases, I'm usually not, I'm trying to maybe figure out if we have a good way around this, but I'm usually not getting a client sent to me or find a referral or anything else. Yeah. Taking the application, and then them going, they're not planning as well. They're not going, hey, I'm going to buy a house in 4 months.
Right.
It's usually 2 months or less.
Yep.
And then as soon as we tell them, hey, it looks like we can do something for you, boom, they're out shopping and they find a house or 3 houses, we offer, right?
Right.
So, but under the assumption that we're thinking maybe together they make 100, we think, or they think they make 108,000.
Yep.
Ooh, that's pretty close to that limit here. And I don't know if when we give NIFA your income, if they're actually going to maybe use 109,700, and then we don't get to do what you thought you were going to do.
Right.
So we have their income calculation tool, but it takes bandwidth and somebody who's not a specialist, but has a lot of experience with NIFA to say, all right, give us all your income and asset documents. We need it all. That's the best advice I can give any buyer. Put all the puzzle pieces on the table. Let your lender sift through and help make sure that they have the full picture to find the right product and to make sure we're not having a problem.
Right.
But if I can give that to my processor and she can look over the income and do their calculations, we have the ability, if we have the time provided to us by the buyers and the agent, to take their income and send it to NIFA and have them look at it and tell us if it is within what limit. Right?
Gotcha. Okay, that's great.
I've got one right now, and we're in process. He's under contract right now. He's buying in Bennington. In 1 year, he made more than this. Yeah. But his last year, he made less than this.
Okay.
But his income isn't standard income. He gets paid some commission, some overtime, and a little bit by mileage.
Okay.
How much of your W-2 was this and how much was that? Right. It's a little variable income. It's kind of hard for me to kind of go. And then he went and found a house 4 days after he talked to me.
Oh, boy.
Now, I know for a fact that he can do the Welcome Home program, and it's a great deal, exactly how we have it stretched out.
Yep.
But I would feel horrible if all of a sudden I find out that I gave him that one at a higher rate when I could have given him that one.
Right.
So we're trying to get it up into our process and get it underwritten through us as quickly as possible. So we have our income figured out, and that'll give me a really good indication if he's going to be determined to be higher or lower. And we have a little bit of time where then I can take the file and still send it to NIFA and have them look at it. And if NIFA says, nope, you know what? He is in the lower income bracket. I already have his rate locked in to safeguard him because we had some moves going in the wrong direction the other day.
Gotcha.
I was like, we're going to lock it.
Okay.
But the day we locked in that rate, if all of a sudden 2.5 weeks later, we determined that he would have been in the lower income bracket, NIFA is great. They'll just go back and change it to what the rate would have been at the lower income.
Nice.
At the other program, right?
Nice.
So try to do what's best, but there are some certain circumstances, and that's why this Welcome Home program has been so great.
That's awesome.
Because it fits the needs for some clients that unfortunately fall outside of that income limit, but still need the assistance or maybe need the benefit of having the rate where it is with conventional or FHA. Even those are still pretty solid rates, right? Yep. So if that's the case, for many, many, many years, I'd have first-time homebuyers come in that needed the down payment assistance, but I didn't even have the products available to maybe give them anything else at the time. And they made just slightly above that income limit. And then it was kind of like, oh, we're getting punished because we make too much money.
Right.
So this came out not only for that purpose, but we've seen a lot of that stuff happen as well. So,
awesome.
Yeah.
Let's see. Clark says, is the loan repayable, or it is? It
is repayable. Yeah, it's paid back over a 10-year period. It's a 1% interest rate.
Yep. And then Fred Sacco, late to the party, Mr. Matney, pulled a Husker offense and was slow off the ball.
Not this year. So
we win the offseason. All right. And then Bob has excellent show, David. Thank you so much. And thanks to Erik for his time. Well, Bob, you're very welcome. So anything else, Erik? I know we ran a little bit long, but I hope that's okay with you. I really appreciate it.
There's great a lot more that goes in and ways that this program can be used to take care of numerous different scenarios and things that pop up in the marketplace, especially in a competitive market with very low environment. Some tips of the trade that I think we talked about yesterday a little bit that I do keep a little bit close to the hip because it's kind of
but they can reach out to you on that.
Some really good things that can be done. And most importantly, here's what I'll lay out. Not only are they, and I'm my little push to try to help, right? apply and apply soon with whoever you're going to talk to.
Exactly.
Make sure if you have struggles or problems, or you might think things are great, but credit can fluctuate quite a bit month to month, especially if you happen to be a younger person with not a lot of credit history out there.
Yeah.
Get somebody to look at that and make sure that your ducks are in a row, because the more prepared you are to make an offer and know what you're doing in this marketplace, the way higher chances you're going to have of success.
Amen.
Second piece of that would be the best time to buy a home was yesterday or last month or a year ago.
Yep.
And rates, sure, they're coming down slowly, but there is a cost to waiting. It's costing you money. I bet if anybody on here or anybody you talk to is probably wishing and kicking themselves that they didn't buy back in 2020 when they didn't think they were ready to do it.
Right.
Or in 2023 or 2024, because that same home has now gone up dramatically in value, and the price and whether the rate comes down, it's the appreciation and the wealth that can be gained by being a homeowner. It's not always peaches, right? There's going to be expensive.
Right. No. Yep.
But the sooner you're in, you can only negotiate the price of the house once. Right. But there are going to be opportunities, and for many different reasons, for refinancing again in the future if rates come down, which all the experts look like they will. Just how fast and how much is to be questioned.
Right.
But if you go back and look at the last 80 years of the prices of homes, there's only been, I think, like 7 times when rates or prices have gone down.
Right. I have that chart somewhere. I gotta pull that up because it was
like those, I think
it's like 5 years out of since 1945. There were like 5 years.
Even in that time frame, in the great housing crisis, if somebody was able to hold on or didn't have to sell the house,
right,
even that dip, that same house is now exponentially more expensive. So
right. And even Nebraska, when you go back and look at that chart in Nebraska, we don't get invited to the party, so we don't get the hangover. We don't have those. It's not a Vegas or a Boise or a Phoenix or anything like that. So, it's a, no, that's a great point. And there is a cost of waiting, and there's people out there on the sidelines that when they're able to buy, that's going to just bring more buyers to the marketplace. So
there's a tsunami of buyers on the sideline. We have the millennials, which was the largest age group ever born, hitting their prime first-time home buyer age, coming to the market when we have some of the lowest inventory we've had. So if you get out there, and you're going to have a pretty high likelihood that there's going to be a shot you're competing against other people. And you want to have the right type of people in your corner to educate you and make sure that you know what you're doing, so that you don't feel like you're just winging it.
Yeah. So. And if you're not ready to buy, well, then start,
let's figure out why, get you on a plan so that we know where you are. That's all.
Exactly.
I don't care if you buy now or in a year or 6 years from now. But if I can give some help to you and get your plan in place, educate you, that's all I'm looking for.
Awesome. Well, Erik, I can't thank you enough for tonight and showing up and being my guest tonight. I really thought it was you did a great job. And like I said, if anybody has any questions, here's Erik's number. Be sure to reach out and give him a call, talk to him, and just have the conversation and just start the conversation. And then that way
you have the ability to throw my email up there.
Oh, I actually, you know what? I mean, here's the thing. Here's share this tab. Let's see, add to stage. Okay, there's, do I have your email? It says, okay.
It's all good.
Let's see. No, I can enter. What is, I'll have to type it. So.
It's all good. It's first name dot last name. So Erik.Soderholm at fairwaymc.com. Emails work.
You're watching me type now, which is Erik.Soderholm at Fairway Mortgage.
Yep, Erik.Soderholm at fairwaymc.com. I can type it into the chat, or I don't know if I can adjust my anything else, but
well, let me see how I did.
But if they go to that webpage,
how do I do there? Nope, did I do it?
Yep, okay. That works.
Awesome. So they have that extended the show another 5 minutes.
It's
watching me.
No worries. It's starting to pick up out there. So
thank you so much. I know you was working late tonight, and I really appreciate it, and I appreciate what you do for my folks. So
Well,
I
I
really
appreciate
enjoyed
the
it.
opportunity, David. God, I got
Awesome. Hey, either way is fine, brother.
And look forward to maybe catching you again sometime. If you need anything else, let me know. I'd be happy to assist.
Awesome. All right. Hey, you take it easy. Thanks again. You bet. Bye-bye. All right, everybody. Well, I tell you what, next week, we're going to have a special, I've got another guest planned. It's going to be a little bit different time. So it won't be at the normal 7 p.m. time. It'll be at 1 p.m. So anyway, stay tuned for next week. I got a great guest planned for next week. And in meantime, if you have any questions or any feel free to reach out, and be sure to keep watching the channel and subscribe. So trying to hit that 5,000 subscriber mark. So appreciate it. And you guys make it a great day. Bye.